Hello and welcome to the first of the series of our videos related to ACCA's paper FA1, Recording Financial Transactions. All our videos are based on our express notes, which you can download from www.theexpgroup.com. Let's now look at chapter 1 in those notes, and let's discuss the business transactions and documentation. In this first video, we will look at what bookkeeping is in the first place, and then how various types of transactions are recorded in the books and what sort of documentation supports that recording. So, if you look at what bookkeeping is, it is basically making a record of all monetary transactions that the entity entered into during the period. The ultimate result of the bookkeeping process is the production of financial statements. And the process starts from receiving invoices, sales invoices, purchase invoices, receiving bank statements, and some other types of documentation which now needs to be processed and needs to be classified, segregated into various pieces, and ultimately leads to the generation of financial statements. Now, in this paper, what we will be dealing with will be, first of all, books of original entry. The first tool of recording all the transactions that the entity entered into. Then we will move towards recording the transactions in the accounts, which now is obviously the most obvious and the most commonly encountered method. However, you need to be aware of the books of original entry as well. Now, what sort of documentation we might have in order to post certain transactions, so include them in the books? Now, first of all, we may have a quotation, like a proposal sent to a client with the price list or the range of services to be provided. Now, this is not a document that would form a source of any posting. We may have a sales order that is like a an order received from the customer, where the customer orders some goods or services from us. Now, technically speaking, it could result in the recognition of revenue. However, normally it's still too early to recognize any revenue based on a sales order. In some cases, in services, if the service starts being rendered right after the sales order, perhaps yes. But in the sales of goods, receiving a sales order is definitely too early to recognize revenue. Now, we may have a purchase order. That is when we send a request to our customer for that customer to prepare some goods for us. Again, probably too early to include anything in the books. Then we may have goods received note or goods dispatched notes. Now, when we receive goods from our supplier, we will record that as inventory. And when we have inventory, we usually have to pay for it. So we will have payables as well. Now, goods dispatched note means that we got rid of some inventory, and it may usually mean that we've got some revenue now. An invoice definitely means we've got revenue, and one more thing, we need to pay to our suppliers, right? That would be in case of invoice received. With invoice issued, with sales invoices, we will have receivables from our suppliers. Finally, after each year end, we usually will send and receive statements. Statements will be documents which are sent between suppliers and customers, where they will reconcile their balances. So the supplier will say, well, according to my records, you owe me $100. And the customer, if they agree with that, they will just sign it. If they don't, they will look for the differences. Other documents that are involved here. A credit note. Sometimes we may make a mistake as a selling side. We may issue too many goods to the client and invoice too many goods to the client, or we may send some faulty goods, and that has to be then withdrawn. A credit note is simply an adjustment, like a correction to an invoice. Alright. A debit note is simply a document that evidences that the refund was made as a result of a credit note. Remittance advice is just a request for payment, and it's usually within the invoice anyway. Now, receipt, as you all know, is something we get in a shop. That is just the acknowledgement that the payment was received. Now, out of all these documents, now the ones that are really important for the bookkeeping the ones you will really care about will be sales invoices, purchase invoices, and bank statements. Now, sales invoices, which in most cases will include goods dispatch notes. So technically speaking, when we issue an invoice, we also issue goods at the same time. For simplicity, in the majority of cases that will be the assumption. Purchase invoices, which will usually include goods received notes, right? So the receipt of goods and the receipt of the invoice will in most cases take place in the same time. Now, these are the three basic documents. Remember that sales invoices can be subject to credit notes, and obviously purchase invoices can be subject to credit notes. When we issued or someone invoiced us in the wrong amount or wrong quantity, that will be adjusted by a credit note. But in general, these three types of documents are the ones that we will care about. Sales invoices mean we've got revenue. Purchase invoices will usually mean that we will have inventory, we will have some cost of sales sometimes, we will have payables. Right? Sales, invoices, revenues, receivables, inventory, and obviously cost of sales as well. We will discuss that later on. And bank statements, which will evidence all movements of cash in bank.